great to have you guys. It has been an incredibly volatile couple of days. Of course, last week seeing a big sell-off, the last 24 hours seeing a massive rally. Today we'll talk about bringing it back to basics using some of the technical analysis kind of foundations that we always like to talk about during these high levels of volatility. And I think we've got a lot to discuss as always. So stick around, ask questions throughout, and of course it's going to be a good session. We will be talking about the S&P 500. We'll be talking about, of course, stocks, bonds, cryptos, and also the commodities markets. So quite a lot to get into. Tyrone, as always, what a volatile 2026 we're seeing, eh?
Absolutely, and welcome everybody. It's been one of those very, very eventful fortnight really, but I think in the last session of trade, we saw some very, very heavy spiking, 10% on oil, which I suppose is not even that uncommon at the moment, but yeah, look, very, very volatile. But I think what's important is that although we've seen very volatile markets, the key support and resistance that we've talked about all along have actually held up really well. The markets have gravitated to them. So we'll unpack some of those on the majors today.
Absolutely. So let's begin with one of the majors. Of course, the S&P 500 coming into focus a lot over the last week, particularly from two of our favorite moving indicators, which is the 20 weekly moving average and the 50 weekly moving average. We actually saw the market break below the 20, which is the first time it's done so since Liberation Day last year. We actually saw a pickup off it in November, and also some bidding coming off it in February of this year. And once we close below that, the 50 is often where the markets will go to next. And what we actually saw was we saw a market tie that went down and then it rallied back up to the 20, acted as dynamic resistance, which it often does, and now it's hit that 50, hasn't it? So this is a very important kind of structural area. The 50 is all important, not just because it's the 50, but also because it's kind of barely holding this support level, isn't it, on the S&P? It kind of broke below, but then we saw the Truth Social post. What are your thoughts on this? Is this still in a bear market, like a bear technical kind of shorter time frame action at this stage?
Yeah, look, on the shorter time frame, it's most definitely bearish. I mean, if you go to a daily like we've got there, you can see lower high, lower lows right through. I think the market, as we know now, is very resilient to world action in terms of unforeseen actions really. And in 2008 we would have seen a 20 or 30% sell-off. Now yes, it's come down, but you know, if you had have been asleep for the last month and you look at the market today, you wouldn't have even realized from the market action itself that we've seen, you know, potentially the start of World War III. So I think in that regard, the market has been very, very stable and very, very technical in terms of trading. Now, the 6750 obviously is a very important zone for this. It came up and tested it. It was actually in a very volatile market. That was actually a very easy trade because from a technical standpoint, the things we talk about all the time, 6750 is an extraordinarily strong roll reversal zone. It bounced off it, then broke down below it, came back and tested it from below, and then down it came again to the next very heavy zone at around that sort of 6580-ish area. Yes, it went a bit past it. But like Tom and I always say, you know, if you've got a target in mind because if it's a strong support or resistance level, quite often the market will go past that level, especially when it's selling off quite heavily. Don't ever worry that you've left that money on the table. Always stick to what you know is good support and resistance. The market's going to often fluctuate past that. Don't worry about that. Look for the next trade. And I think from a technical standpoint, I think it's been very, very easy to trade. And again, you know, even in times of very heavy volatility and uncertainty, the key market levels hold up. So it's always good to aim for them. It's been a really good trade, actually.
Yeah, it's been interesting how these moving averages have really held. I mean, I think that's, as Ty said, that when the VIX is above 25 in particular, sometimes going back to basics and sticking to, I guess, the more liquid, large position areas in terms of your technical analysis to try to get a bit of an idea of what exactly is going on can be really key. So we've got here the 20. What I did want to just kind of detail here was the 200 SMA, which is a very popular moving average. And the reason I want to look at that is because that Truth Social post actually pushed us straight up to that daily 200. And you can see here that last time during 2025, when we went underneath the 200 moving average, it actually rallied back to that area and it acted as dynamic resistance. When eventually it took and went higher, that was actually a very significant area. And you can see here again a false break to the downside and then a new higher high. A lot of people look at the 200 moving average on the daily as kind of like a basic sentiment report in terms of whether the market is more bullish or more bearish in terms of technical analysis. And in this case, of course, yeah, we are seeing some of that appearing here. So a very important level, 6,600, what an important zone for the S&P. Huge amounts of activity around here. But as we're looking at that 2-hour, 4-hour chart, we can see here that the 20 moving average is continued to come down and then actually find that as resistance. And it's not just this market tie, it's also happening in gold as well. If we actually go to the gold charts, I noticed the 2-hour 20 has also been a really big sticking point. The market just absolutely just fell off a cliff with gold, and it's now come back. I'll just show everyone. It's come back to this previous period of what we would call support or demand in terms of structure. It's funnily enough come back to the weekly 50. Sound familiar? Very similar to the S&P, and it's found some bid over the last 24 hours, but it's still very early to tell, because as we often say, to stop a freight train or to stop something like an elevator going down, we really need quite a lot of structure. Has it done enough for you yet, gold? I mean, it did bounce a lot in terms of dollar amount, but that was a pretty sharp sell-off. Do you think it's going to sit around here for a little while and consolidate?
Yeah, I think that, look, the next move around this moving average, I think is going to be very, very important. I think it could go up. If we just go back to the daily for a second, I really like that. Yeah, I think what we can see from the standpoint of the pullback, I mean, went all the way to 4,100, right? I mean, it's a massive pullback already. Like, it's a massive pullback. Yeah, realistically, I just want to see another day unfold, to be fair, on the indices and on gold. The fact that we're seeing markets react on a Truth Social post just worries me. I'm not going to lie, it does worry me a little bit that we're paying so much attention to a social media post that can move a market, because what that does, it creates an element of what can and can't be taken for granted. And I think I just want to see the market play out for another 24 hours. It had a massive rebound. That's one of the biggest rebounds like we've seen on gold since effectively February, really, which is saying something given how high it went. So, but you're right, I think it's pulled back to a really strong level of support. And if it can maintain this level, especially above that 20 moving average on the 2-hour that you had before, it gives us an opportunity to get back up to those next key levels around that sort of 49, 5,000 again. But very important above that. We need to see a sequence of higher highs and higher lows for mine, trading above the 2-hour 20 right there. And I think that could give us an opportunity up to around that sort of 4,900 to 5,000 is probably the first real very heavy level of resistance. And we've got to be mindful, of course, that all of the support and the resistance we're talking about is relatively new in the context of history of gold. Like, we've only just broken up here, obviously in the last few months. So we've got to take those levels for what they are, that they are, yes, they are support and resistance, but they're also very new to what the market is. Doesn't mean they're going to be ignored, but we just have to be mindful that they are relatively new levels of support and resistance.
Got a question, exactly. We've got a question coming in here from John. He says, I think it's helpful to understand the behavior of different assets in unusual situations, so we know what we can expect in the future. Would you agree initial selling of precious metals such as gold, silver, have been washing out a lot of people's positions, or what he looks as weak hands, which is obviously a term used online, of speculative trading before potential movements after that? So I think the thing is that you've got to position this as okay, well, what would people be doing? We obviously saw that the huge volatility event over here. That always, I think, is a sign of a market that is becoming uncertain. So obviously we've all heard of the stories this year of people lining up for gold. People here in Australia, where we're from, I think they were lining up, hours tied by bullion. So it was clearly a bit of a phenomenon. Then we saw a huge correction, and that then recovered. And a lot of people look at that recovery as, okay, it's all good. But a lot of the time, this is the warning sign. This is a huge amount. That's not just normal volatility, that's extreme volatility. So it's not unusual for markets to then move into this period of extremely high volatility. We're actually seeing something similar in the Kospi, which is the South Korean market, which is a market that's gone up like, I think it's like 100 and something percent in a year, 180% or something like that, thanks to AI and hardware data centers. You can see a massive volatility. You can see here it's been very volatile, moving between 5 and even 6-7% in a session. So this is the type of thing that happens when you do go into those kind of parabolic style markets, and we're seeing a very similar thing in silver. So could it be, you know, that people, that these markets are taking lower lows to take people's stop losses out? Certainly, and that's why the reaction from this point is going to be very important. Usually, though, in these situations, it takes a while, doesn't it, to structure up?
Yeah, it does. Look, it does, and I think that patience is probably key here. I think we just have to let the market settle down a little bit, show some proper technicals of key levels, make sure these levels are starting to hold up on their own right. And by that I mean not just on a speculative text or something that we don't want to be part of that. Look, you know, as traders, we want to be better than that. We don't want to be part of the ebbs and flows of news. We try to avoid all that. I mean, you guys have all been around long enough to know now, you've been watching the webinars for a long time, that we like stability and predictability and technical analysis. So while the markets are fluctuating, you know, 6, 7, 8% in a day, that's not the sort of trades that we're really after. We want stability. So what we want to do is isolate a level of consolidation, and then we either see a series of higher highs and higher lows to give us some stability, or lower high and lower lows, not necessarily meaning it has to go up. It may well keep going down, but even then, a lot of people would still be saying there's probably a correction, yeah, and probably rightly so. So I don't think there's any right or wrong, but I think what is important is that we actually maintain our heads and not just try to jump in on the next big volatile move. Let the market actually show us the way. And when we work with the market, the results are generally going to be a lot more in your favor. I think that's probably the best advice that we can give you in a very volatile market, because it's tried and true. Tom and I have seen it all. Yeah, we've been here for a very long time now, and we've seen, yeah, this is just another event that happens a lot. And like I said earlier, the market becomes more immune to these events and it's actually a far more stable. Had this happened in 2008, oh boy, oh boy.
Would have been 2006, 5. Can you imagine?
Oh,
it would have been 15, 20% down.
Absolutely, yeah, overnight. And really, you know, now we can see a lot more resilience in these key markets. And I think that's really good for traders. I think that makes the opportunities even better, because they're a little bit more predictable, a little bit more tradable. But still patience needs to prevail. I think it's never more important.
Let's go back to basics here on the NASDAQ for a second. 24,000, very important level. Markets actually didn't really get underneath it by too much. You can see here that by the time the market had actually closed on the futures market on Friday and then opened on Monday, we gapped below and we end up finding a rally thanks to, of course, that post. The thing is, though, daily 200 comes up again here as potential resistance. And again, if we go down to the smaller time frames, you can kind of see that if we put a volume profile through this entire thing, what we end up getting is a huge amount of transaction through this zone, and we haven't actually come back up to that area. So for bulls to really regain, or I guess the buying momentum to regain back into these markets, we actually have to see some of these levels be broken above. And I think at the moment, you know, the markets are still very uncertain. We're seeing certain key bonds. So I guess we want to just quickly have a look here at certain key bonds, such as what we call high yield corps or junk bonds. They've actually broken below. These are closures below previous supports or previous demand zones, and that's not exactly like a positive sign, is it, Ty? So when the bond market starts to get a cold as well, you've got to be looking at that and the macro side a little bit differently. But I think what it shows us as traders and investors is smaller time frame analysis has to be a little bit more nimble when the VIX is high. And of course, we need to be really thinking about our risk management more than anything else. Risk management's key. Understanding that there are certain moving averages that often get hit, VWAP levels that often get hit, and then of course you're really just playing the statistics at this point when you're looking at these markets. But at the moment, the markets are still positioned, I guess, you know, negatively in terms of technical analysis theory. I think that's what we're kind of getting at here, isn't it, Ty?
Absolutely. Yeah, and I think that, look, it's important to, I think this is when your toolbox of things that we've been talking about over many years with you all now comes to the fore. Yeah, your VWAP, your moving averages, your support and your resistance. It's now that they're the most important, really. Like they can really guide you and help you where others are guessing. You know, the tools that you've learned with us, yeah, they're the ones that are going to help you right now. So it puts you in a position of power, in my mind, that you can make informed decisions at good level, sensible decisions, I think is probably the best way to describe it. So yeah, really, really important. And look, we've seen some massive moves on a lot of the key world markets too. I mean, I know you got the thing here as well. This has been a really good technical trade as well, hasn't it?
Well, I mean, I guess the unfortunate thing is this was a pretty good level of support or demand. We started to see some bid of it, but then of course with the escalation of geopolitical information, obviously it came back down. And now we're back at that kind of, again, role reversal-y kind of moving average area where the previous support is now acting as resistance. So what I'm trying to show everyone is that the correlation of these markets seems to be across the board. We've got gold back to something that's continued to find selling pressure on it. We've got the S&P at 6,600, such an important zone. We've got the NASDAQ at the 24,000 area, which of course was broken below on Monday and then reversed thanks to that Truth Social post. And then we've also got it even in Bitcoin, although Bitcoin is not a market that we're looking at from as much selling because it already had the sell in it. You can see here that the market did recover a little bit off this structure. And then where did it go to, Ty? It went straight into resistance. So there's so many markets, you can see here the little resistance goes. So many markets instantly recovered to this area, and now they're all waiting for the next bit of information. You know, are we going to see, I guess, more escalation? Are we going to see de-escalation? That's probably going to be the thing, the news story that's going to push these levels. But I think it's important to note that we often go to the next level, and that's why technical analysis is so powerful during these times, because of course, if markets, let's say, de-escalate and everyone feels like things are improving, then where's the next level of resistance? I think you'd agree, Ty, it's around this area, isn't it, here on Bitcoin?
It is absolutely, it is, yes. And I think though, the other thing we've got to be mindful of as well, and you've got to put your thinking cap on in terms of what does de-escalation actually mean to the market. Yeah, we've got to remember a lot of the things that have actually happened, they're going to take a long time to recover regardless. Let's just say the fix is made and they have a meeting and everyone agrees, all right, you know what, enough's enough, let's get the world back. You know what, key installations have been bombed that aren't going to be automatically online. There is still going to be an oil issue, even if the Strait of Hormuz opens tomorrow. A lot of refineries have been hit. There's still going to be things that need to play out over a longer period of time. So don't automatically expect that even a de-escalation is going to send the markets to record highs, because there's still the fallout of what's actually happened. It's still going to take quite a bit of recovery. So I think just be sensible about what your trading expectations are. Don't expect that Bitcoin's going to return to 100,000, for instance, or the S&P is going to hit all highs next week because they've come to an arrangement or a deal. Things are still going to have to play out in due course. So just be mindful that when you're setting your take profits for targets in trades that you're putting on, be sensible about the approach in terms of what you expect. And there's no better way than looking at resistance in front to take profits, is there, Tom? Like, there's nothing better than what's been there before, where you expect the market to stop, to actually take some profit off the table and look at it from a new lens after that has happened, rather than just assuming that, you know what, 100,000, here we come on Bitcoin. It's just you want to trade it. Real traders don't do that. So just be mindful.
Yeah, I think it's important to, you know, what you're doing in trading is you're playing your statistics and you're playing your system. You're not really necessarily just saying, oh, random numbers. You know, you want to be trying to build a confluence approach to everything. Let's have a look at the US dollar here for a second, and you can see that the market has continued to find base, but it hasn't actually broken through that 130. Now, a lot of people expected it to get through based on probably the Monday session. It actually fell off a little bit here. And a lot of people are talking about the petrodollar system and all these other things, Ty. In the technical world, though, the main thing is flow, and we're still in a very tight range. I wouldn't necessarily say this is negative for the dollar yet, but it obviously hasn't broken through that key resistance level. I mean, if it gets through 130, do you think it's, you know, very strong for the dollar and we could be going towards maybe levels up here? I mean, this to me is a very pivotal level. Obviously a little bit here as well, but I think 130. Your thoughts on 130?
100, yeah, 130, 150, very, very key breaks there, I think. And the other thing you've got to be mindful of for the dollar, for people who like to trade the dollar index as well, it's very important to remember that even prior to the 28th of February, before this actually all unfolded, it was already heading up. Like, momentum was already turned up, and it was starting to strengthen, okay, well before any conflict started. So really, I would like to think that Yeah, and I think this can play it both ways. But I mean, sometimes, you know, whether it's a de-escalation or just a standoff or whatever, the dollar index could still rise. And I'm very keen on it getting above. I think this pullback to the 20 was probably more to do with the Truth Social post than it is actually what's happening with the dollar, to be fair. And I think that all it is a pullback and doing exactly what you would expect in a market that's probably going to go stronger. So I don't think it's necessarily all over. I want to see it close obviously above 150. And then I think that opens up a good chance to get to the 101.80, which is one of my favorite levels on it. And there's still quite a bit of trading to do that. So that's obviously going to see a weakening in the euro. But it's important to remember and keep in mind that the dollar index was already heading up well before any of this happened. So yeah, we would hopefully expect that it would continue its rise in a de-escalation environment, because that really puts it back to the 28th of Feb.
Yeah. All right. Well, I think that's, you know, again, really critical level, 20 moving average, obviously super important, and the dollar needs to be paid attention to. Now, we have seen obviously a lot of interest in oil. Oil is really tough when it becomes in the press. So that is, everybody starts talking about it. Again, it kind of reminds me a little bit of gold, where we get this huge rally up, we get this huge movement towards the downside, and then we go into a holding pattern. I think for traders, you know, what happens here is that people have to, like, everyone starts talking about 150 a barrel, 250 a barrel. I've seen some people say 300 a barrel. You know, it's some crazy numbers out there. And when that happens, you often see price action actually remain relatively kind of more stable. And that's kind of what's been going on here with oil. We can actually see it's priced itself between two ranges. And if you were a trader, there's a little like kind of trick that I'll show you guys, which is the 1122. And what that is basically, if the markets hit one side, so here's one side, then they hit another side, then they hit the other side, then they hit the other side, that maybe the next, you know, touches are going to be good for range bound kind of action. Now, obviously we see the Truth Social post push it through, but you can see here there was one buy, one sell, maybe one loss, but these are fairly tight stop losses. So you can kind of see here the 1122 would have been pretty good. Now, in terms of breakouts, Ty, you obviously expect the range, and it did the range in about a minute. So that was, you guys witnessed history, you know, in terms of what you just saw over the last 24 hours. It's another one of those days you often don't forget. That's actually not quite the range. 1 second, let's just make that proper. There we go. I can see it's magnetic. So you can kind of see here that, you know, instantly went down, and that's that channel pattern style formation. So it just goes to show, like, you know, technicals work in these times. It's just that this one was so ferocious that if you had little bid buys here with tight stop losses, well, instantly the market would have obviously taken that stop loss out. But the 1122, pretty tight range, obviously opportunity in a market that was pretty volatile. Ty, what do you think about that, and how maybe a technique could be used in the future along with your already existing systems?
Yeah, I think with oil, if you're going to trade it, you must be trading small time frames. I wouldn't be looking at anything past probably 2 hours, maybe 4 hours at the absolute most, because look, it's difficult. I personally don't trade anything that is, you know, expected to move 10% in a day, especially when it's something like oil, because there's just way too much volatility. And I think there are better trades out there actually that make more sense from a technical standpoint. But that's just me. If you're really hell bent on trading the volatility, and there's nothing wrong with that as long as you're trading it the correct way. There's no better way to do it than isolate smaller time frames, find these channels like Tom's isolated here, and look between the boundaries, because quite often is the case that the market's going to bounce between levels it's familiar with, comfortable with, and tested very recently, as you can see, the 1122 system here. So if you're going to trade it, absolutely you should be focusing on the smaller time frames. But you know, there are still a lot of good trades in this in this environment. I'm not so sure oil is one of them that would be getting me excited. I think that I don't like things nervous. I like things that make me relax. So oil makes me a little bit nervous, just like gold does right now. Again, if you're going to trade at smaller time frames, absolutely 2 to 4 hours, really solid, and just aim for those areas. But just be mindful that if there can be slippage in very volatile markets. That's what makes me nervous. That you can't totally lock down a stop loss, because you know a 10% move often has gaps. So just be careful with that.
Yeah, you often, exactly. That's the thing. It becomes very fast moving markets, like 1%, 2% move in 1 minute. Like that becomes illiquid, and therefore there can be gaps. So you got to be careful there, guys, or slippage. So I just want to kind of end here with a couple of key charts that I think we're watching. One of them is copper. It's come into this minor demand. You can see here, most people are going to see this as a technical head and shoulders, left shoulder, head, right shoulder. That is a pretty big breakdown last week, Ty, technically. Obviously, if it's going to go range of the head and shoulders, then you're looking at further downside on copper. So this is not a chart that I think is that exceptionally good for trading or investing or anything like that, but it is a chart that you're watching for a sentiment. So that's going to be one of those ones. US dollar before, and we often call it the backbone of the US market, and that is, of course, the semiconductor positions. Like 170 has held up so far for NVIDIA. You can see here this 172, 172, 172, 172. You know, we don't want to see, you know, the biggest stock in the world taking a lower low ideally as well, because that's starting to show weakness across probably, I would say, the most important sector in the market, which is semiconductors. And you know, again, on that point, you know, you can also watch semiconductors themselves, and you can see here that we have a level that hasn't been reached. So what do you think, Ty, if these all close below? That would be kind of bad for the markets, I would say.
It would be. I think that what we need right now is stability, and I think that we don't need to see breakdowns of this market. I think your 376 is a line in the sand for me. I wouldn't want to be seeing it closing and trading underneath there on a big time frame daily. I think that would destabilize a lot of different sectors that may surprise people that aren't even linked to semiconductors. So a little bit like oil affects, you know, almost every sector in the world. Sector is a little bit similar in the sense of stability, I think, right now. So we want stability, because stability means reliability and repeatability, and that's what we want. That's what trading is. That's what technical analysis is. So let's just hope that our yellow Great Wall there can hold up, Tom.
All right. Well, from all of us here, we want to say thank you so much for taking your time to come and view today's session. Obviously, volatility has been up high, but to summarize, I think one of the things that we saw in the last couple of sessions has been that moving averages 20-50 have remained pretty stable actually in this environment, if you can believe it. The other thing is that we're seeing, you know, technical breakouts in zones towards the downside, but instant reversals because of the news. And what that means is smaller timeframes. When the VIX is above 25 in particular, Tyron and I have always talked about the idea that when you get the VIX that high, you want to be starting to focus in on the more liquid pairs and really keeping it back to basics. And I think what we've shown today is a lot of cross correlation as well with the market. So important times, very important level, and maybe over the next couple of sessions, we'll get a bit more direction and structure, Ty. So thank you so much from everyone here, Pepperstone, and we appreciate you guys. And remember, if you want to subscribe to the YouTube channel as well, do so in the links in the description down below. And yeah, we'll see you in a couple of weeks' time.
Absolutely. Thanks, everyone, and look forward to seeing you in a couple of weeks.
Thanks so much, guys. Bye for now.